Hey everybody, it's the Market Sniper here, and I'm going to talk to you about our X-rated interest rate super spike theory. This is something we've been discussing and putting forward repeatedly, but we've not done a single video that is specifically dedicated to it. We've regularly referenced it in many of our particular recordings. And this particular video is going to be all about it. So what is it that we're saying? Well, here's what we're saying. We are saying that instead of a small pullback in interest rates, what you're going to find is something totally different. You are going to get the next major move will largely be to the upside in an uncontrolled and aggressive manner. So what that means is we made a number of targets. Don't forget, on the bond markets, we have been the guys that called for 5%. We'll show you those technicals in the charts in a minute, amongst a lot of other interesting things we're going to cover in this video, including how the X-rated interest rate super spike is actually complementary to Ben Johnson's milkshake theory on the dollar, and we'll show and discuss with you how those potentially overlap in terms of how things will go down. And why will rates go up is the question that many of you are asking. The economy is surely not that great and strong, and why would the Fed and the Fed's chairman and his committee allow for rates to go up? Now, here's the thing with rates. Under most economic circumstances, the chairman and his committee are controlling it. So this is a boat on the open sea in good weather, riding parallel to the coastline and staying roughly a kilometer out at sea, and just holding the steering wheel a little bit left, a little bit right, like a little bit of a rate increase and a little bit of a rate cut, and you're plowing at 50, 60 knots, bouncing along that swell, but pretty flat in stable environment conditions. What tends to happen if that environment suddenly changes, and it didn't suddenly change, it started to get more choppy anyway, the decision of the bank, the central bank, the Fed chair, and the Fed committee is no longer made by them. It is made by the market events in the debt markets. So for this, we need to do a drawing, and we will do it right here on top of these lovely ladies to once again illustrate that debt is a function of both rates and the value of that debt, and that is an inverse relationship. So there is our seesaw, and on the one side you have one little person sitting, and on the other you have another, and one is the value and one is the rates. So where this represents rate, this will represent valuation. Now normally what we're continually doing whilst we're steering our boat and just lightly adjusting the steering so that we stay in equidistance from the shoreline, well out in sufficiently deep waters, but we're going along the coast broadly, we're adjusting lightly. That seesaw is just being fine-tuned. What tends to happen is if there is too much debt. Now, once you've had a certain amount of interest rate moves, you suddenly have an interest payment which is far more substantial, particularly if on the 40-year bull market, you loaded up on an immense amount of debt. That is the hand in the sweet jar we used to use as an analogy. You grab too many sweets, you can't even come part of the way back up holding all that debt in your hands, which I'm putting as chocolate sweets. You have to let it all go, and it must fall down to get just your hand out. So you grabbed up and you loaded up too much on the way down, as it was just staying broadly affordable on ever lower interest rates, which turned on the key events of March 2020, when we had a super high valuation of debt and a capitulation in rates being paid during the events of a total lockdown where only the mega corporates, the Zionist mega corporates, were kept open and all small businesses were destroyed, and then all sorts of money of stimulus, lots of theft, laundering at a government level, at a local government level, at the top level, at a transnational level went on, lots of political boondoggles were funded, including transgenderism and various other things that needed a bit of money, and future pandemic, various things. So there was a big, and the odd man in the street got $1 out of the 100 that was created in the name of helping the man in the street, and of course that caused such an addition in debt, and now we've had the fastest interest rate climb. And what that means is we're now spending in America more on the interest rate than we are spending on the entire defense budget, which is already outlandishly large. And what that also means is during that low period, Yellen, who was the Treasury head and an ex-Fed chair before she became Treasury head, which is a political post associated to the Democratic Party. Previously, she was supposed to be in a politically neutral post, but clearly Democratic sympathetic. Not that left or right truly means too much in this discussion. And in the end, she did too much short-term because it was slightly cheaper. If you borrow out on 30 or 20 years, it's a slightly higher in terms of base points. She went for 1s and 2s to ever make more and more of the lowest interest rate she should get. Now, what that means is the borrowings of a year and 2 years ago are all coming due now and need re-rolling. Only they get re-rolled at a far higher interest rate. At the same time, that new borrowing has never skyrocketed more enough. So Americans essentially, in terms of tax payments, are spending twice what they get in, and they're looking to do $2 trillion in deficit this year alone. $2 trillion in deficit alone. So what that then does is when you have a huge increase in supply of something, does it maintain the same value? So when we shut down and we kill demand, which is the same as creating excess supply, what happened to the oil price? Well, guess what? Not only making single digits as we predicted, the cash oil price traded zero, and the futures price actually went negative $42. It cost more on storage than people just didn't want it. There was a glut. Excess supply led to a collapse in price. That was part caused by a sudden kill in the demand side. Now we have a different situation. We have excess supply entirely on the supply side coming ever faster. And the more it requires larger interest payments, the more we can't make those interest payments. We have to create new supply to pay the interest. It is a self-perpetuating doom loop. People are saying, how can inflation get higher? That we're going to get higher interest rates. Nobody's spending, everybody's giving back their repo car. You're thinking about you, the retail guy, the man in the street. You see, your government, by proliferating ever more debt and issuing more and more and more to cover these ever larger interest payments, and the fact that you're paying less tax and they've committed to the same spending with a certain increase each year. So most of the budget is not even discretional, it's pre-committed. And of course, they're doing boondoggles to Israel for everything that they're doing in the Middle East, and of course, Ukraine and a number of other places. So all of those emergency requirements that must receive capital, even though Israel is already the biggest aid customer because they're such a poor, impoverished country, you are now sending ever more money and you're paying ever more interest and you're getting ever less income, and you've got a bigger interest payment to make. So new money is being created so that you don't collapse. It's kind of like the acceleration point of a vortex. When you've been borrowing on all your credit cards and you've maxed them all out, and then suddenly the interest rate goes off the teaser rate onto the full rate, and now you have to get 10 times more credit cards with new credits to just pay the interest only bill on the 5 that you've maxed out that are no longer on teaser rates. How does that work out? You get into an absolute doom loop that leads to collapse. In the process of collapsing, the value of the debt, because that debt is an obligation to somebody who's bought it, that person who bought it and has it as an asset, that is the taxpayer's liability to the banking cartel that got given the exorbitant privilege to create money, That's right. We gave them that. We could, at a government level, have created our money, but we let a cartel of people borrow that first dollar into existence and then create an interest environment of tertiary extraction. And they've created wars ever since and funded wars and conflicts, much like Israel and Ukraine and many other things, and a military-industrial complex, till they're spending way more than they should, because you now owe them interest rates. And who's you? The taxpayer of the nation state that's not doing it. You are indebted to the cartel for which they gave the privilege to create your money by doing it on the loan the first dollar into existence with an interest rate basis, which means ever more you have to keep expanding the monetary supply because interest payments have to be made. The dollar has to come from somewhere. So given all of that, you are getting inflation, not because you're spending too much, but because the government is needing to create so much new money that is diluting your dollars. If the number of dollars is 50 trillion and I then immediately create 150 trillion because I'm having to create new borrowings, another 100 trillion to meet interest rate payments on the 50 trillion, etc., etc. Essentially, you've lost immense buying power, and that seeps into the larger ecosystem of dollars in circulation. So you're wondering, everybody's fine, the growers are fine. Why is cocoa hitting record highs? Why is live cattle hitting record highs? Why is sugar hitting record highs? Why so many softs? Are the farmers suddenly getting greedy? What? No, the total amount of money that's being created through the cycle is seeping out and out and out. And as a result, you're being diluted. In actual fact, that cocoa getting more expensive is the buying power of your dollar falling. But how come I don't notice it? Because the other nation states are all synchronized to be in a similar state by the Zionist central banker cartel that had them make the same errors of hyper-indebtedness. So you are all parachutists that are falling to the ground and will die unless that chute opens and operates. And gold is the plane that is flying at the same altitude, and you are looking at the euro as the dollar and saying, we're actually doing decently against the euro and not too bad against that Swiss parajumper and not too bad against that Chinese parajumper and that Canadian and all of that, and you are all falling at various rates. The relative valuation to other currencies has no meaning if all nation states have committed the same degree of sin, which is why in a previous video, when we did gold, we showed that gold was doing exactly what it should do against the yen, against the Aussie dollar, against the British pound, against the euro. In fact, the month that finished in October, 80% of the pairs, gold versus the other currencies, gold was at an all-time monthly close high. So if there's inflation not brought on about you're not buying a lot, new money is being created at an ever faster rate to meet interest rate payments that are got ever so much bigger on a super tightening cycle that, of course, Powell, thinking he's Volcker, well, he doesn't think he's Volcker, this whole thing breaks up. Everybody wanting to compare it to the 70s. It is not the 70s. We gave you the phrase. We gave you the key phrase long time ago, and it was this phrase: hyper, that means extreme, stagflation. That means exceedingly low growth and unbelievably resilient, consistent inflation. Do you get it now? I can't fit my N in. There's an N at the end of that. Hyper stagflation. The theory that Francis Hunt has put forward to you and has mentioned consistently, and I bought in 2007 the URL for globalstagflation.com a long time ago, because that was my prediction of what came. It is the antithesis, the antithesis of the Goldilocks economy, which was, hey, there's no inflation, all our workshops have gone offshore, and we can just drop interest rates ridiculously low, load up on debt, and push up asset valuations to crazy highs. That is the binge before the bust. 6 months of day leads to 6 months of night. You're on the North Pole, have a nice winter. It's going to be dark for quite some time. Okay, that's where you are, hyperstagflation. So back to the valuations. If you are proliferating, as we saw, there was an effective glut in oil. Given the environment, the oil price utterly collapsed in value. In fact, it went negative, but there's a carry cost associated with a physical commodity that doesn't exist for bonds. That is essentially nothing more than a contractual obligation to owe somebody a stream of payments as per an interest rate and then a return of capital. So what happens when the valuations collapse down? And by the way, we just had an event, as we were describing, where blamed on a hack on, can you believe this narrative that they've come up, a hack of a Chinese intermediary system. You know, China used to be a big buyer, so they had a special system. They could put their bids direct into the Fed's bidding thing. You didn't have to go through the primary dealers, which are essentially the banking cartel that owns the Fed, that is owned itself by Vanguard and BlackRock, that own all those same banks, such as JP Morgan, who themselves own most of the equities of all the big equity companies, who themselves are also owned by the City of London legacy families, which include the global rich elites and big names that are controlling all of this and organizing a systemic collapse for which we have continued to warn interest rates will be the nanothermide of the collapse of your personal finances. The nanothermide of the collapse of your personal finances. And what we're now finding, having been that guy that took you to the charts and showed you TLT many years ago, look through the writing, let's take it off. We suffered many people talking about how awesome bonds were and everyone should buy bonds and what an upside bullish pattern that was. Raoul Pal being one at this very moment, and he repeated it again, ironically, at the head and shoulder neckline. He's not the only one. I'm not doing him wrong. He's got many things right and is an interesting person to listen to, but he was definitely wrong there. Buy bonds where diamonds was a mantra repeated by many others. And this particular point, we said no. In fact, this structure that I've highlighted in blue is one of the most deceptive, and it's typical. And I've made the same mistake of thinking that is an upside move. And it is one of, in our examples that we share, of the most treacherous setups for a downside. And it's usually associated, we call it the blow off with harsh slap back in the face, and it is a steeply ascending inverted HVF where there is so much buy value because people have been trained on a bull market for so long. Remember, the bond bull market is a 40-year bond bull market that every time you bought the dip in bonds, you only made money. You got it so ingrained in you that there could never be any other outcome until there was, until the post-COVID events. And what actually happens here is that you get a seminal macro major reversal, and it has a very steep blow-off, which is a warning. It is typical of the dot-coms and others. You get a blow-off event, then you get dip buying that actually looks like it's going to continue to the upside. You get a squeezy Japanesey just like that with a very steep basing ascending grind line, which is what I'm saying here, steeply ascending, because everybody's so well used to it only going up. This is one of the most dangerous first inverteds in a new trend, and it absolutely calls a top. And not only do you make the target, you continue to fall for an extended period. So those are some diagrams, and this is the particular setup that we're referring to. And the bond market met that criteria right there. And that was the turn. We actually called the short on the inverted HVF on that break, and then we said the head and shoulder will occur on the make of the target. You will get some form of rally. It was a bigger rally than I thought, carried on for a while, but did our head and shoulder come? It sure did. Did our target get made? It sure did. Did you get a wee rally and some progress decay for a while? You sure did. And did you trade to new lows, and are you now having a mini rally? You sure are. But is that valuation from up top there move it out the way. 172 in comparison to the low that's traded 80. For bonds, that is huge. Bonds are the boring, stable market. You've gone on a long-term ETF. What are we actually looking at? Let's just be clear on what TLT is. It is an ETF made up of 20-year and plus, 30-year and longer US durations. So it's a portfolio of value of long-term debt, and is absolutely been smashed down from 170 down to 80. And my friends, it's my opinion, it will go a lot further. This was a seminal head and shoulder call and collapse, and we were in on it at the top of this head, except the very blow off super spike, typical with end of trend markets, that coincided with our analysis on the gold silver ratio, for which we said you may not get it all straight away, but the gold silver ratio has turned and overshot to such an extreme degree that you are now going to get an overshoot in time, not overnight, that will be equal by measure. So the degree to which you overperform one side, and this was a super high gold silver ratio spike, is the same to the degree that it will break down. So you might ask, why has gold not broken down to the same degree as debt? Because people are understanding the failure of the debt system, and the last thing the central bankers require and will allow is for precious metals to highlight their great error and predicament. It is the canary in the gold mine, and it'll be one of the last that gets to sing its song. But sing its song it will. Why? Because it is the anti-banker. It is the anti-banker option, and that is why they have CBDCs already waiting in the wing, Bitcoin, crypto, and everything else, all to steal some of the thunder of what will be the biggest reversal in gold silver ratio and absolutely drive gold and silver. So if we go back to that video and we redraw with our lovely ladies who still haven't had a chance to speak yet, we redraw our valuation versus rates for bond markets. Value, rates. When you get an environment where the absolute issuance is getting so much faster and bigger value, and the payments thereon are getting disproportionately more expensive because your interest rate cycle turned sharper than any time before in terms of how much, how fast, what you get is a glut of bonds. What happened with the glut of oil? You guessed it. We gave you that trade. We were short oil. We were short it all. You know it very well historically if you've been following that particular during that period. You got an absolute collapse in pipeline companies. You saw a collapse in Carnival, which was a cruiser liner, and you saw an absolute collapse in oil. For the first time in 35 years, we were in single digits, and of course you made zero. So with such a glut in issuance of debt, what do you think happens on the value side? Well, the problem that happened on the treasuries last week is that, and this is the biggest news that not enough people are talking about, is that there were insufficient buyers, and they've made out that there was a hack narrative to it and that it affected one of the Chinese intermediaries. The Chinese are not buyers. They've actually been sellers. So anything that stopped them, the only thing it would have stopped them from doing is selling. They've not been buyers. In fact, Japan and Britain have stood in to try counterweight the balance. By the way, if you watched our Professor Werner video, you will know the Bank of Japan is totally under the control of the Federal Reserve following World War II. Go and watch that. And of course, you'll know the City of London is part of the Axis, as I've already described in terms of who owns what. And they're going to keep those plates spinning until they're ready for the crackdown. So they're waiting for their numerologically special day to do this. And how will it happen? Such proliferation, such weight of supply, what will it do to the value of bonds? This is what happens, my beautiful people. It will utterly collapse, and the number of people that want to be buyers are the amount of people that truly want to hold a hot coal in their hand and give up good hard-earned money to do so. They will not want it. They don't want it. It could go to zero. It could go exceedingly low in value. It's no use earning 5% and losing 65% in capital valuation. That is not a return. Return of capital will become more important than return on capital. If those valuations go down, the interest rate super spike, let's go back to black, will absolutely rocket up top here. Anyone with debt will face that thing we've been warning you about for 3 years, long before Kitco, and God bless them for putting this out, they're doing a great job, long before Zero Hedge, long before anyone else said it. You're going to have a debt-based collapse that's going to spike interest rates. Get debt out your life. It is how they will destroy your personal finances. And of course, it will be exceedingly good for gold in spite of the diversions of cryptocurrencies and many other things and central bank digital tokens that they'll no doubt rush out. And don't forget, whilst this crisis is taking place on the financial markets, the least and last thing they want is for you to be focusing on that. So imagine the geopolitical events that could see an extension of the war into Iran, chasing Hezbollah here, and into Syria, chasing bad guy there, Muslim bad here, Muslim bad there, bomb Lebanon, bomb everyone. Hey, we're doing a genocide. Let's go entirely the whole caboodle. And that could be one of the distraction strategies. Something else could be one of the distraction strategies, which could see Russia get involved, Turkey get involved, or it could be Taiwan, China. Who knows? They could actually trigger a number of things that will see everybody geopolitically talking about everything except the financial event that will destroy their personal finances. And I'm here to warn you of that. Don't get sucked into that narrative. Unless you're in a war zone yourself, the most important thing is you preserve your finances and you become better off for this rather than getting destroyed by it. So the collapse in valuations on bonds, as shown on the seesaw with a fat boy on this side now due to excess supply, will see rates spike. And the Fed doesn't have a choice, because if no one's going to buy their debt, they have to keep allowing it to devalue until it reaches a rate at which people are happy on that return of capital to risk their capital in the first place. And if the yield is insufficient, you could have a super spike to 20%, potentially more. Listen, it won't stay there for long. The whole thing blows up. It's a super spike. It's a short, destructive event. Globally, the emerging market nations that have been indebted in dollars will have insufficient dollars, and that is why our theory actually overlaps quite nicely with Brent Johnson's larger theory on the dollar milkshake. Let's wipe our face and make this a little bit fatter, seeing as we're drawing diagrams all over our ladies. There is the Francis Hunt interest rate super spike on debt collapse and devaluation and deficit spending getting out of control, hitting a parabola that is creating hyperinflation. That even though you're not spending and you've never felt so bad, and they told you the economy's never been so good, they will be forced to raise rates, much as the British had to do to defend the pound. By the way, this pivots, now that I've mentioned the pound, into a currency crisis, which is where the milkshake theory comes in. The milkshake theory is here. Milkshake and the super spike, the debt fail rate super spike. We get X rated debt. That is over there. So the two things occur. What happens? Money is borrowed into existence. So as the interest rates go up, the Fed will be obliged to move first because they have the most debt and they have to keep it liquid. They will have to push rates up. That's a milkshake. That's a terrible spelling, isn't it? Go K. So I'm lucky I didn't type MILF shake. It might have been a little bit Freudian. Anyway, we don't want to get distracted now, do we? Debt fail, rate super spike. absolutely leads into the Fed having to push rates higher. It absolutely leads to a number of pension failures where they can't pay out to their pensions and they have to keep the debt valuation keeps going down. And what ends up being the case is rates have to spike in comparison. You can't have a seesaw where you borrow money into existence and interest rates and valuations of that debt do not have that relationship. It is like two sides of an accounting journal. There is an asset and a liability. And of course that leads to currencies. So the ones that are running the lower rate, their debt will fall faster, and when that happens, their currency relatively will lose value. So apart from the debt fail and the rate super spike, the third element of our theory is wild FX volatility and spikes. Wild across majors, guys, we're not talking just the Turkish lira here. Number one, the beginning of debt failure due to excess supply. One. Number two, rates super spike. That's the bit that destroys your personal finance because you have debt. Number three, wild Forex. Most of it positive for the dollar, terrible for emerging, and terrible for many of the rest of the nations, particularly the likes of the yen, particularly for the likes of the Korean won. You are going to see almost crypto-like macro tier one nation FX outcomes. Any nation that fails to rate hike at the rate that the Fed is doing on the dollar will immediately fall behind and will battle to service any dollar denominated debt, bidding up the dollar ever more, that there will be insufficient dollars in the market to pay the interest rate, because as the interest rate spikes, the need to pay more on your debt occurs, and you're not earning that in offshore environments such as South Africa, Turkey, that is borrowed in dollars. Let's hear the girls, after quite a lengthy explanation, how they are now coming to the same conclusion we gave you 3 years ago. And don't forget that debt 40-year chart that we did for you. It was the interest rates. I think it was the 10-year. Let's have a look. I did a 6-monthly chart, 6-year, 10-year, called the turn of this market. Might have been the 10-year. Let's just see. I'm not even too sure anymore. Monthly, this looks like it. Let's go. We need even more. We need 6 months. 6 months, probably a tiny bit much. But that is the Volcker years to where we are currently. My friends, it was plain and obvious. Blow off rates, that you would then go into a sustained bull market for bonds for an extended period out of the Faulkner over reaction and need to tighten excessively. That has now set up the subsequent bear market for bonds after a simple, plain and easy channel that looked like it would never end. The yields got lower and lower and the valuations got higher and higher. Remember the seesaw. Then we turned after the events of March 2020. We told you in the same year on that May turn that everyone's wrong about buy bonds where diamonds. It's going to probably turn. There's an inverted HVF potentially. It's that first ascending structure which is most deceptive, that is actually part and parcel of a collapse, not the next bull move up. I showed you one of the charts. We've seen that. We had one in oil like that in 2014. We've had it in crypto. It's a very deceptive structure because it has a very bought up bottom, and that is the final exhaustion of the bulls before real stuff changed. Look at this rate change, and it's going to go higher. By the way, on the 6-month time frame, let's just clear up my mess and also the lines here. You will see that so far 1, 2, 3, 4, 5, 6, 7, 6 months. That's 3.5 years. You have not had one single half-year session that was a bearish session. That means rates have not for 6 months, one single candle of 6 months, been able to pull back and close lower than they started. In every half-year duration candle, you have finished that half year higher on rates than before, after a ridiculously long Greenspan-induced post-Volcker liquidity experiment designed to pump everyone into indebtedness for the subsequent failure. You had to kiss the leper, become indebted, and every nation state followed, coordinated by the same central banking cartel that actually is owned and controlled in every single nation state. And you have already been in a financial new world order for an extended period. You haven't even understood that. Many of you haven't, many of you have. Okay, back to our girls.
2022 to 2 trillion in fiscal 2023.
I know. And unfortunately, it looks like it's going to keep rising because, interestingly enough, the year 2020 was the year where the Fed or the government spent the most money. They had the biggest spending spree because of COVID and what have you. This year is the second biggest. And really, the only thing that's different, aside from the normal expenses the government makes, is that interest rates have gone up, like you said, from 0 to 5.5. And that is really increasing the interest payments that the government has to make. And if interest rates keep rising because of this mega trend, then we're going to have deficits that just keep doubling and doubling. And so that's something that's a big concern. Right now, interest payments are already equal to what the government spends on defense, for example. And that's supposed, by next year, the year after, it's going to be far greater, one of the greatest government expenses. And that is going to balloon those deficits to the moon, practically.
Yeah, servicing that debt is becoming a really, really big concern. Pamela, you have been focusing, as much of the markets have been, on the 10-year yield as well as the 30-year yield, because recently 10-year yield breached 5%. As a reminder, yields go up when prices
reached. I also want to highlight that we have actually, and we don't get credited for this because we're not mainstream media, we're a small YouTube channel, but we have given every single major HVF, including a W bottom with a target of 4.92, and we said it's likely the full number of 5. These are in YouTube's, countless of them. We have told most of you that cared to listen long before it happened that you will see 5% coming. And this was down here where it was down at 3.5, a W bottom. Don't put that stupid tag there. 3.3 over here, you ended up at 5. Many people never thought you would be at 5 from 3.3. They called this the top. How many pivot callers have there been? Now, admittedly, the buy bond where diamonds guys have gone a lot quieter in the last year, and the pivot callers have gone a lot quieter in the last year. But boy, did we have a lot of them in 2022 and 2021. Boy, oh boy, and the buy bonds. Now, of course, they might be a tiny bit more circumspect. The 5% we told you has happened, and as a result, you get a pullback. Everybody will think, that is it now. The economy is not that strong, it's going down. Wrong. Wrong. Read my lips. Wrong. It's got nothing to do with how poor you are feeling and how little you are spending and how little effect you're creating inflation. It's got everything to do with the statist government's rate of new money creation that they have to pay on that other part of the world, the financial world you never see, that is them needing to pay high interest rates on existing debt and money they don't have. What do? They create it. How do they create it? They borrow it into existence. At what rate do they borrow it into existence? The new, much higher rate. And they've got to pay the interest on all those other debts, plus roll all the 1 and 2 year debt that Yellen issued during March 2020, and the COVID events, etc., that was done only on short term, that's now coming due, has to be rolled again, plus the fact that your tax is down because you're crushed, and they're still spending the same amounts, and in fact they have normal escalators on those amounts, so most of it is committed. All the stuff I've covered before. They are creating your inflation. You don't see why there's inflation. You can't see it happening. How can the price go up? It is about the currency devaluation. It isn't getting any harder to grow a cocoa bean. It isn't getting any easier either, but it isn't getting any harder generally. They'll tell you, oh, but that was caused by a drought here and a crisis there. But then, hold on, why across all the soft categories has something happened? And after the drought or the flood or the whatever the excuse is going, the earthquake in Brazil or the whatever, does it never return back down? The valuation of your money is collapsing. Hear me now. The valuation of your money is collapsing, and you are not seeing the perpetrator that is proliferating it, and now because of interest rates being higher has to proliferate it at an ever higher rate to make his interest payments on the old debt, roll the short-term debt that he should have put out on a longer time frame, and then still issue new debt for this ever greater expenditure that they are doing, even though they're trying to cut expenditure because your income has gone down and the tax receipts are lower. Okay, so we've got over that. We gave you this. We also gave it to you on the 30-year. We said the exact same thing. Upside HVF target on the 30-year. You will run 4.7. You will probably go further. You ran the 5.1 and you are now in a pullback stage. Is that the end? No, just like we told you over here. It's not the end. Just like we told you, and everyone said, it's the end, look how far we went, look, you can't go up anymore. No, long period, not so much, until you started going back up again. You can't break this cycle. You don't stop a snowball that has gained inside halfway down a mountain that is on a gradient like that halfway down. You don't stop it. You don't get to, okay, stop right there. No more. Let's cancel. Bad idea. No more down. It hits the village. It hits the village. The problem started long ago when you were atop of the mountain and you made that first smaller ball and began its progress on rolling down the hill. The whole avalanche is coming down. You don't get to stop it. It is game over. This will happen. Hear me again. To you. It's game over. It will happen. Back to our ladies talking deficits.
Prices go down, so that signals less demand for U.S. Treasuries to have a rising rate. It pulled back a little bit when we heard from the Fed that they're pausing at this meeting. But what is the bond market telling us? Why is it so important to be paying attention to the 10-year and the 30-year?
Oh, it's vital to be watching it right now because the fact that it shot up as the way it did. Sure.
This channel, we have consistently, in our community, my daily updates, what I teach all my students and members and participants in the trading game. I taught people to understand debt and to watch the 10-year and the 30-year Treasury. And we watch British, Italian, and many others too. It is so imperative. And we have mentioned it on our free view YouTubes that it's time to start understanding debt. I released a pod on a podcast explaining debt, the bond market, and I put it on auto tweet for an extended period. I've been trying to make people aware of debt and everybody doesn't find it interesting. It is the money that is borrowed into existence. She is 100% right, and we've been saying this for
Rates as well. They all shot up. Now they're due for some sort of downward correction, a pause, a quiet period. And this is what the Fed is suggesting about continuing rates unchanged. So that 5% seemed to be like that's the tip, that's the top for now. But the 10-year and the 30-year move in lockstep. They're very close together. We use the 30-year because it's the longest dated issued by the federal government, but the 10-year is the most popular one. But either way, they're the same. And this is saying that if it goes down to 4%, 3.5% right now during a correction, it still doesn't change the fact that a mega trend has changed and it's going up.
Now we are seeing people saying, what day is it? It's 12th November 2023. A mega trend has changed. Where did you hear that first? 3.5 years ago, right here from this laptop, from my workstation. The events of March 2020 were seminal. You also saw the lady with the red hair there saying 2020 was the biggest expenditure year. That was the greatest proliferation of issuance. They took it. They spent money they weren't getting in. Nobody was working. They paid salaries. They paid business bonuses. They set this up. That was your final little drink that they gave you on the house for free before sending you in the bus over the edge of the cliff. It is absolutely the trend change. Debt doesn't take 40 years. How many times have we also said the following? Escalator for 40 years up in value, elevator inside 4 done downside. All that upside done in 4, because you never fall like you go up. Short debt is the macro trade. We said it when Druckenmiller said he didn't understand it's the most difficult markets, he doesn't know the ideas. We said, how is he not talking short debt? How is he not looking at the specific Japanese situation, which is the most over-indebted and doesn't have the exorbitant privilege of currency and has the lowest interest rates? The furthest to fall debt is the one with the lowest interest rates. All these things are verifications of our macro view and standing that we have given repeatedly over time, and now you are seeing everyday conferences, the financial experts and specialists being interviewed and making these declarations. They're 3.5 years late, but they are arriving. Once it becomes common knowledge, it's a problem, and it gets worse, because who wants to be a bag holder? Do you want to be the buyer and the bid on debt, and the bag holder that could be the idiot that bought and lost 75% of value so that you could get a 5% coupon paid at the end?
It's just starting.
So you're not seeing any pullback anytime soon in terms of interest rates. I mean, we had Fed Chair Jerome Powell, signaling that they've paused again. Markets are pretty much expecting another pause come December. But you think that the Fed is going to stop but hold at this rate?
Well, it seems to me that...
Before she answers, what the interviewer doesn't understand is that once things get disorderly, it's no longer the Fed's choice. The market decides. If everybody becomes a bond seller and there's not enough dumb money and toxic bank money to be a buyer, the rates automatically go up in the market and the values go down. That seesaw again. What happens is the Fed is forced to change its rate in accordance to what the market is giving you. The minute you have any degree of free price discovery mechanisms, if they are not monetizing and buying it all up themselves and turning into a toxic bank, the other participants will be dumping the debt. And the proliferation of new money means the inflation is going to get well higher than the interest rates being paid. Who wants to be paid less than the future inflation rate because a proliferation of money is being created that is utterly... Inflation is money proliferation. It's not price increases. That's an outcome.
It's time for some quiet time because everyone is so upset about this rising rate. The rates just went wild, and the Fed knows that. So they want to just calm things down. So yes, a downward correction would be totally normal now. Say that from the 5% it hit, so 30-year it went a little above 5, and they come down to even under 3%. You're still going to see
under 3%. We have been. So I disagree that you'll see under 3%. Why? Because I'm a technician as well. I not only understand macroeconomics, I'm also a technician. This is how we've gone up. Like that, pullback. Like that, pullback. Have the lows of any of these pullbacks ever got lower than the previous low? No. Why do you expect that to get down here if it hasn't happened? This is Dow theory. You are in higher highs, higher lows season. That was a small pullback. Higher highs, higher lows season. Higher highs and higher lows. That low is unlikely to be here. It's just continuation. Go with the continuation. 40 years of trend has changed. This is going to hurt and it's going to happen fast. Short debt, particularly Japanese, but any will do, especially if they're liquid. Okay.
And that's why
So if they
correction.
start cutting dramatically to 3%, is what you're saying?
Well, not necessarily. It can just float down. It can just, the thing is it looks like it's just going to be some time out. And the Fed will have its, it seems like it would be to advantage of the Fed. Then they don't know if they're going to raise rates yet or not, but the market tells us they're going to raise rates. But maybe it's next year. Like it could be months away from now before you see another rise in rates.
So you do expect another rise in rates. You do not think the Fed is done?
No, not at all. We think they've just begun.
The Fed has just begun, Marianne.
She's shocked because she doesn't understand. She doesn't understand the fullness of the need to print your future interest payments, which is compounding on compounding in an environment where the rates are now significantly higher. So you're not compounding at 1%, which takes a while to bite you in the arse. You're compounding at 5.5%. And you've got extra debt that you didn't put out on long term that's coming back at you.
I mean, we've been saying they're going to raise until something breaks. Things look like they're pretty much on breaking point. Do you think there's more room for the Fed to continue raising?
And that's why Pam said
they will raise in a crisis. It doesn't matter if things are already breaking. They will no longer be in control. The super spike comes as declared by the market as debt valuations go to zero, as your pension gets destroyed. That is stuffed with government debt. That's what happens. The market rates will be forced. Think the pound that hit 15% interest rates. The central bank, which was the Bank of England, did not choose to put interest rates at 15. They had to keep announcing and going in accordance with what was happening in the debt markets. As everyone sold the pound, they sold the treasuries, the gilts, which is the gold-plated certificates of British debt that are golden good. Only you should have gold instead. Oh, well, it seemed people didn't want them. They were selling out of the pound and they were selling out of the government debt. They had to push rates to 15%. It was over in quite a short time, but a lot of people sold their houses at the bottom of the market and were forced out. That was a tiny microcosm of what's coming. And 70s is a tiny microcosm of the hyperstagflation that we've been talking about for 3.5 years. That ends with a dollar spike, an interest rate spike, which the Fed will be forced to be at the front of, and a debt collapse.
they're due to cool down, come down a bit, and that could last for months. And because the mega trend, you have to remember, lasts for decades. I mean, so it's not something that's going to be, next month.
Girls are really struggling to get her to understand there's going to be a minor pullback. It'll be a minor pullback in my view, but time will pass with rates being lower for a while. Some of the sting out of the headlines will go. They are not going to make a lower low as per the technicals, in my opinion. Do I know for sure? I would say on balance of probabilities. They will be back and a problem sooner than people care. And the moment when it gets disorderly will absolutely come. That's what these two ladies are trying to say and get the interviewer to fully understand. She's probably just extracting the argument. I know her to be smart. So that is why we will get to gold and silver, no doubt. But what they are saying is this is a macro trend. I cannot agree that this will take decades. The point at which things get disorderly to the upside, we'll see a multitude of failure. And unless they keep holding it up and monetizing all the debt to such a ridiculous degree, it won't particularly last decades. It took 40 years to put on. It will be over in 4. It's not running for 10, 20 years, creeping up interest rates in the same way they went down. Unfortunately, it will be contagion. When contagion takes over the markets and the markets all lose confidence in debt, they all sell at any price. They don't want to make zero. They'll get anything out. Return of capital now becomes preservation of capital error. We've spoken of the key trends. The search for yield in the bond market ever strengthening and rates lowering has given way from March 2020 to the return of capital preservation. And once more people realize that and get short debt and get out of debt, there's going to be no buyers except government, and they'll be forced to be a buyer, and they're putting you, the taxpayer, on the hook. So what she's trying to say is the trend has changed. I can't agree with multiple decades of rising rates. I think you may get 1 decade or under a decade from, if you count from March 20. I would say it's more likely to be over in 4 or 5 years in an absolute collapse, and you end up in central bank digital tokens. In short, a crisis will ensue, and you will be distracted by geopolitical events that will be made to escalate, more war footing and everything else, yada, 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 and there will be great impediments on your freedom of movement in many ways. So the whole draconian lockdown will be brought on our heads.
They could calm down because they've gone too far, but then eventually, probably next year, rates will start up again. We can't tell you why, but you can assume it would probably be because inflation is heating up, or some forecast, a recession.
Why would inflation heat up? She doesn't explain. The point of the inflation is, as I've already explained, the proliferation of debt and the proliferation of the interest payments required to maintain that debt, otherwise the system fails. That's your inflation. It's not you buying a car that's going to do that. It's not you doing something small and going on a holiday that'll do that. People are doing less of that already. There's a reduced participation in the labor workforce than for men since the 40s in the US. So let's just be clear. It's not the consumer. It's the system that's now on the wrong side of a parabola. It's the massive snowball and avalanche that's already halfway down the hill. The inflation is guaranteed by virtue of mathematics and compounding, assuming even if the whole world consumer-wise didn't buy another goddamn thing.
We just don't know what is going to be the trigger, but rates will start up again next year.
Well, many in the markets are expecting the Fed to cut. Now, granted, these people have been quite wrong so far, because nobody really thought the Fed would have the gumption to go this high this quickly. But the sentiment is that this tightening is going to really start to show itself in the markets, in the economy, and that the Fed is going to be forced into a pivot by, say, mid-2024. Do you see that? Because it sounds like you don't.
Well, you know what it is.
No, so no pivot. You don't see a rate cut.
Well, it's not the Fed's decision to have that. That's the whole thing. They go with what the market is telling him.
This is what she doesn't understand. The interviewer thinks this is all a system that is totally controlled. When people stampede and sell, decisions are taken out of the controlling people's board. It's like the Fed controls. They don't control who goes to war and how effective bombs are. They can't control certain things. This notion, the illusion of control, this godliness, this pedestalizing of these clowns that have absolutely, they're not even clowns, it's intent, and it's coordinated intent across all nation states to mask the fact that it's happening, because currency by currency, everything looks fine. She's trying to get her to understand the market will take the decision.
Like telling Jerome Powell, the market moves and he tries to accommodate as best possible.
Well, technically, they should not be watching the stock market, right?
Well, not the stock market. They're watching
The starts, not shares. Debt markets, debts. This
the interest rate market, if anything else, and bonds. That's what they're watching to make their decisions. So if you see that, so that's why it's really not him as a person
Well,
or
sure,
an
it's not
entity.
him, but it's the committee, right? It's the
Well, no, I don't
FOMC.
mean even the committee. I mean, it's gone beyond them.
So what would make them hike again?
Well, inflation could make them hike again.
But they're not joining the final dot, inflation. She can't see that inflation is going to get bad because things are tough. And she's hearing the consumer's tough. What she doesn't understand is it's not about us. It's about the Ponzi scheme. It's about the high interest rates, the debt payments, and the ever-growing shortfall that is going to see new money created at a more rapid rate just to keep maintaining itself. It's now consuming so much fuel just to keep running. And they have to dilute ever faster, ever more. So it will be inflation, but it will be system-based inflation, not consumer inflation. Ponzonomics at the very end of its life scale with compounding interest, with higher interest rates, and new issuance at an ever escalating rate means new money created.
And we certainly have inflation that's not easy. That's not easy to take that away. And so, and that's their fight, to fight inflation. So they can fight it all the way up. And so inflation is here for a while. It's not a fleeting thing. And like many people are waiting for it to be temporary. We don't think it's going to be temporary. We think we're having another
100% right. It's built into the system mathematics. It's in the mathematics now that you're at 5.5%, and it's in the debt. You are someone who's earning 100K with a 5.5 million credit card debt, and you spend 200K a year. That's where you are. You don't get to, and the rates have gone from super cheap 0.3 to 5.5%. So now you're going to be spending more of your 100 you earn on the interest. That means you're going to have to, you can't pay your mortgage and your other things, so you're going to borrow even more. So you're going to go to borrowing more than 200 to 250, 300, and your income's actually going down. And the buying power of that income's going down, and the interest rate payments on that 5.5 million are going up. It's unsustainable. It has to end. It only ends in increase in rates because the debt must collapse in value, because there's going to be an utter proliferation a la the glut and oil.
1970s on our hands for the first time ever. Since the 1970s, this is the first time 1970s looking very familiar to today's world. And
right.
It's far worse than the 70s. It has strains of familiarity. Hyper-stagflation. In the 70s, blanket bombing, Agent Orange, all of those chemical warfare and murder and bombs cost money, yes. And you took it off the gold standard and you printed dollars, so you were devaluing the money. Fine. But once you stopped devaluing the money at the same rate, a la Faulkner, who came in the 80s, you could fix it. You can't fix the snowball halfway down the hill. That is the system. The avalanche is falling. You don't put that snow back up. You can't glue it back up there. There's a difference. It's hyper stagflationary, and it is total and fatal. It is not something you can work through off with a couple of dodgy decades.
I mean, inflation, what last reading for core inflation was up 3.7% year over year. And I always like to emphasize, Marianne, that this is the growth of inflation, right? It's only grown further year over year by 3.7%. So even if we get inflation down to 2%, that still means prices are increasing by 2% from where we left off in 2020 when we started to see this dramatic increase. So if the Fed continues to have this fight against inflation, the thinking is that it may need to give up that fight in the face of other factors. For example...
So you can't. So the game is, we'll just let everything drop. We can't do that. We can't put rates too high. It'll kill everybody. So here's what happens, is if you don't stay out front, it's like saying, that's a bit like the car's careered off the road and is bashing through the bundu, and it's really bumpy and you're up angles and you're smashing through bushes and you're crushing them, but you still got all this momentum. You go, well, maybe we ignore all that and we just climb in the back seat and we say, we're not steering this anymore. That's not a strategy in the situation I've just described. You will be forced to keep turning and crashing through until you've brought the entire bus to a halt, and you're going to want to keep it from rolling. So you're going to look for the flattest bits, and you are in panic control mode, and you're forced to stay ahead of it, because if you hit into a super big wide tree, it's going to cut the bus in half and everyone dies. So you're not in a good situation, but you don't go, we just can't handle that. It's too much. It's bad for everybody. The situation, we'll go sit in the back seat and we'll ignore it and we'll talk about something else, have some dinner and make everyone feel better. And say, we don't have to deal with this right now. No, you've got to stay riding the bus, and you're forced to turn and choose between hitting that big rock or a somewhat large bush and smashing through the sandbank until you've seen the entire trauma out and it plays out. Because it's either a bad outcome or it's an exceedingly bad outcome. You know, you either, most of you badly battered and bumped up, or you're properly dead and it's rolled. The point is, you stay at the wheel. You can't ignore. This is the main plumbing of the financial system.
flaring geopolitical tensions, right? There's so much uncertainty in the world, and servicing this debt, which we just discussed. So what's going to win out? In your opinion, you think inflation wins out over these other concerns?
Probably. But again, that we're just, making an educated guess because it could be any number of factors.
It's a certainty. I mean, I respect him for using probability and not saying believe and things like that. It is always a probability. I can't really say it's an absolute freaking certainty. Nobody's been to the future and come back. But it's as close to a probability-based certainty as I've ever got. The system is on an escalating parabola of debt issuance and debt interest payments. It kills itself. It is a vortex. You can't stop it once you're in the parabolic phase.
And we're talking,
the wars and all the other geopolitical things that the interviewer made reference to will be part of the distraction from the cracks in the financial system. And they will absolutely create all forms of distraction and probably lockdowns. They might do a lot of demand destroying things to try hide the inflation, which will again bring the suffrage on you to reduce your expenditure as if you created this. Meanwhile, it is the inherent design of the Ponzi-nomics system in an ever-escalating parabola of debt and payments that are now out of control. They will blame you because of your oil victim. You will be scapegoated as the inflationary driver, and the consumers have brought this on so that they can blame you for the Ponzi scheme they created and synchronized globally that is now coming into its end game, and that they can lock you down and justify green lockdowns, whatever they want, very much like COVID, which were huge demand destroying events that killed the price of oil right the way down. It would be super helpful, in fact, for the central banking cartel and their co-opted governance partners to absolutely destroy all forms of normal demand from consumers to try cap and buy them more time on a parabola of money creation in the debt markets. So be warned, they're very good at
next year, the year after, we're talking longer term. So it could be any number of things.
Let's talk a little bit more about this debt servicing, because this really is such a big deal. It's a very big concern. The latest to really hone in on it is Jeff Gundlach. He's the CEO of DoubleLine, has about $140 billion of assets under management. And he's saying recently that even if we stay where we are, we don't hike any further, servicing this debt could be the cause of the next financial crisis.
We agree, and we really like him. We like his thoughts.
As good or how much they like him and how much money he manages, he never said what we said it when we said it. These guys are all coming to the party now, and that statement is absolutely correct. They don't need a further interest rate hike. We're past the point of no return. It only ends one way, as far as I can absolutely say about the future in a certain sense. And he is now saying this, but he didn't say it in March 2020. He didn't say it any time in 2020, and I see what he says. And he should have sold all his bonds. I think he did some maneuvering. I can't remember the details. I haven't been following him that closely. But he should have got out of all bonds, and he should have a massive short position in the bond market. And he should have been putting it on in 2020 at that key moment in the charts, which we showed you. That was way back then, when just after this event over here, boom, and you started the first move up. Anywhere along here, you could have had reasonable expectation. And we pointed out the 3 will fall. We told you about this funnel that was growing up here on the 3%. We said the 3 will fall. I think I'm on the 30-year this time. I think it's only on the 10-year that it's drawn. Let me just bring it up. There was the 3-year macro funnel. You'll see that there. That was the downside. This is when we said bonds will go up one more time. This was the squeezy Japanese to the downside, technically, on here, that gave you this funnel. We said the breaking of the 3 to 3.2 rate, resisted, key breakdown, target eventually made. This was an utterly seminal moment. You could have got and you would obviously break it and have a pullback. It's natural. Price behavior is run the key level of significance. You've got to run and jump it like a horse jumping a fence. You've got to take a step back, wind up. You've got to run with some momentum. You overcharge after you've cleared the fence, and then you pause and you rest. It was an exertion. That's exactly what's happened. Break, pull back, and then continuation. Continuation is your friend. HVF method, Hunt Volatility Funnel, is a continuation-based method, and it is a macro technical job that we do. And as we've said before, we're probably the only macro technicals. We're not the best, we're the only ones, because more people should have been calling this reversal 3.5 years ago. So we're making progress with our ladies, and we're hearing what they have.
And yes, it could be a trigger. We don't know what the trigger is going to be, but we do know something is going to trigger. And this is the more likely one.
So there's going to be a trigger assigned, and they will give you a geopolitical event. As I've already explained, the trigger is the end of the financial system, which is designed to fail on escalating debt adding on an ever lower interest rates. Now you have an interest rate environment turning. That's the trigger. It's going to fail. They will assign a final last binge in debt that will be because of this war, because of that climate crisis. We had so many fires, we had this, everybody must be locked down, da 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 da. This is why, and you've created it because you bought too many oil cans to fill your car, etc., etc. You're going to get scapegoated, gaslit. All of that's going to happen, without a doubt. And you did it, and that's why you need to suffer now and make it right. You binged, and now you need a detox. That's how it's going to be. But all the money laundering, all the Ponzi-nomics, all the corruption at the top level, all the theft at the Zio level is going to be the real reason. They will give you a name like Greenspan said, black swan, subprime, whatever the case. It wasn't a black swan, utterly predictable, and it was a binge. That was a smaller cycle binge in a much larger cycle. So the subprime debt binge cycle on housing is a smaller cycle. 2008 was the outcome. Utterly predictable, caused by excessive debt, caused by the impossibilities of serving it, caused by a hypervaluation in an asset. We now have a super hypervaluation in a massively proliferated asset, with an ever-growing trajectory of supply, debt. You don't need a name. I'm telling you the name of this failure of this system. They will give you some of the moment straw that breaks the camel's back bullshit headline. It is the debt. Hear me now. It's the fucking debt. And the interest rate crisis, and the systemic design, and the amount of shortfall, and the amount of spending that keeps leading to more and more debt and bigger interest rate payments. It doesn't matter what name they give you. They're gonna lie, they're gonna manufacture something. The system is destined.
Is the debt, servicing the debt.
Okay, so of course investors want to know what they should do in this environment. Now, you have said in your latest forecast that you are pulling out of the equity market, that you're looking for an opportunity to sell, to take some profits off the table. So break down that strategy for us.
Well, the thing is that the rise in rates so far hasn't hurt the stock market that bad, but it is beginning to put downward pressure on stocks. So if the Fed takes a break, or rates take a break, come down a little bit, we would use that. That would be positive for stocks. Stocks are very happy when rates go down. And on any strength, rebound strength, we would lighten up on stocks if you are heavily into the stock market.
Well, we have seen a bit of a rebound in the market, staying with that point following this move from the Fed.
But a further.
Are you using that?
That rebound is on the pullback from the 5%. In actual fact, the stock market has gone pretty flat down. Now, I want to say one thing about the stocks. Certain stocks will actually do well in a high interest rate environment. Miners, if the gold and silver turn out, they will suddenly do well. But if we just have a look at the SPY, it's going to be a totally different environment. Tech generally hasn't enjoyed higher interest rates. You've been getting such a snapback rally. By the way, inside the hyperstagflation theory, you have to remember that money is being devalued. This is a process of money being devalued. So stocks aren't just a big collapse story. even ones that are interest rate sensitive will come down and possibly sell off in a demand destroying event quite hard, like COVID, but only come back. But because of the inflationary side of hyper stagflation, there's no economic growth, there's negative growth. We're already in a recession. We had the recession. We met the criteria. They told you it's not, because they decided to change the definition. But because of that, don't forget, we're already in a recession and the stock market is where it is. Anything that provides any form of future income is going to get some insulation from inflation because it is a yield stream delivery. So anything that has positive earnings or has growing positive earnings for this economic times and climate will provide an income stream. And if prices go up for food, then prices of the shares of food companies will go up and their earnings will go up, probably commiserate with the inflation rate. People might eat a little bit less. People always talk about food as a defensive. People eat less and they also drop the quality when they squeezed. So, Lidl's and low-income supermarkets that do more cheap and basic foods could outcompete the plush ones, assuming the super rich will continue to eat at the super rich places. It's the middle class and the upper middle class that are going to get hammered. The ultra high net worth, the high net worth, ultra high net worth will still be eating their caviar and whatever that is they do, buying it from the best stores. But the middle upper will be flattened as people drop down into the more affordable. The outperformer in food will be people do eat less, so food will still get less profitable. There will be reduced volumes, but it's a necessity. And people will grow more themselves. They'll become more self-reliant. The barriers to that entry are low on the things like greens, and those kind of things will become more popular. So groceries will lose some power as a whole, and the very lower end will do better than the middle end. But that's just an example of one category. But the prices, as things cost more, everything goes up. If they double the amount of money, the share price will double, assuming it's maintaining its market share and its margins. If its margins get a little bit squeezed, it'll go up 50%. You'll get a partial hedge. So I'm thinking certain equities may give you a partial hedge against inflation, not the full. I don't think equity is my primary choice, but the inflationary part of the hyper stagflation, the stag is the loss of growth. That's not helpful. But the inflationary part, the devaluation of money, will see equities, because they're delivering income streams, be sustained. So it isn't as simple as equities. All equities are going to be a big ass short. Let's hear what they're recommending.
To offload?
Not yet. No, because we think it'll rebound a little more.
I think it's going to be a few months. Several months.
There's still some upside left in the S&P 500 in the market.
Yes, we think that this bounce could go further in order to exit.
When you say exit, which sectors in particular?
You could have a very high S&P in an absolute economic wasteland where it's just the super rich that own shares and everybody else is spending less. But it's been a partial hedge, and it could be at all-time highs. The market is not the economy, especially the economy for the everyday man. If the shares are owned by the ultra-high net worth, 90% of them, as many of them are, it doesn't matter that you're wrecked. You're still buying your wheat bix, you're still doing that, and they're still getting some profit out of you, and everything just costs an extra zero on your number, and the share price has got an extra zero.
Or are you exiting, and which equity sectors are you staying in?
Like we would probably exit the transportations and industrials in general. Like we still like certain sectors, but be very selective. Like we like the energy sector, certain parts of the energy.
Be careful on energy. Oil gets hit on demand destruction. Not all energies. Gas in winter, heat your house. Yeah, some people will go without and wear the extra jerseys if they're really feeling the pinch. But US oil, if you have a look at it, is being affected. Delivery, everything else, down, down. We warned that there was pressure to come on a demand-destroying event for oil. You sold off, you went into a broadening structure, boom, bosh, bosh, and you broke the broadening structure and you're breaking to the downside. Yes, you're getting a wee rally now, but that was far more bullish when you had the falling wedge and the upside move. You're not got that now. So it's not going to be all the way down. By the way, they said they might do more cuts. That's why you're being bid up again. They might maintain or extend cuts, etc., etc. So a commodity that's being held up on account of cooperation this time, unlike the previous time when Russia and the Arabs weren't cooperating. Now they're actually cooperating on production cuts like an OPEC plus. It's not a strong commodity when people are throttling supply to maintain pricing power. It is not a super dominant. It is not a very good sign for the global economy. This is what I'm saying. It's a balloon. There's two balloons. You know when the guys twist balloons to make dogs for your kids? There's two balloons and it's been twisted. There's the government debt Ponzi-nomics in the big part. In this little part, which is retail consumers of the globe, it's actually quite stressed. That's why the oil price is down. You've got a hot war in Gaza. You've got a hot war in Ukraine, although it's probably winding down because the Ukrainians run out of other people's money. But nonetheless, you got hot wars and you're going into Christmas and it's winter in the northern hemisphere coming, and oil is trading down in an environment where people are jawboning about they'll throttle the supply chain. Not a big demand case, a macro demand case for delivery oil.
And we may be going into AI as maybe a small position, but there are sectors like the gold shares, and so there are sectors that we will stay in or go into, but not be in your common stock that moves the market.
So let's recap. What are you pulling out of? Which sectors, maybe even which shares in particular, are you pulling out of when you see the opportunity to sell?
Well, right now what we have are ETFs. So we'll talk ETFs like the transportations and the Dow Industrials and the S&P 500.
Okay.
And the S&P pretty much is the NASDAQ in many ways. So, and we have the NASDAQ, so we may pull out of that too. Or maybe we'll leave it. We'll have to see how it goes. But yes, those are the ones we have.
How much of a...
Not specifically overridingly confident sounding, but going into AI but pulling out of the NASDAQ. Well, a lot of that growth was NVIDIA, which is an AI play. Most of it is 7 stocks, which is actually statism. What I feel she wants to say is invest in statism, which is the grand big players that are the surveillance finance mechanism, like Microsoft, which continue to make money out of ChatGPT. That kind of AI play, those are big players, they're massive cash generators, and even when the consumer gets wrecked, yes, they will fall a degree, but they have state-based contracts that will not go away and will continue to be funded, and those are the servers that keep all your surveillance information that are being scraped from all the social media, Facebooks, Apples, and Trojan surveillance tools that we have on every device. Those are not going to go away, and those are statists, they're dark states, and they're omnipotent, and they're oligopolies. So they're going to be cash flow generative, and when inflation comes, they will go up in inflationary terms. You can play pretty safe in that environment and try have a little bit more of the AI sexiness. Okay, more statism, more control. I see all of that. By the way, on the crypto side, all the status tokens, including Ethereum, which is status, are going to go up. Not because they're good, not because they're libertarian, they aren't. They're controlled by, and there's a lot of corruption with them, all via the government surveillance mechanism. So when you read about corruption on Ethereum, I've seen various other articles with big government parties, rather than it being a negative and that we're going to resort to honesty and truth, understand we are going into a dystopian, totalitarian, surveillance, finance, loss of privacy system. That the corrupt government officials, so corruption at the highest level, almost means rather than that crypto is going to fail, that it's destined to do well, and it is part of the policy, like Apple, like Schmoogle, like YouTube, like Facebook, with all, oh, I guess we lost some guy's data and all of that. They all interface, managed by the Atlantic Committee, sharing their data with the government, They are part and parcel of the matrix network for you to live your life and give your dandruff in metadata to the greater state to sell it back to you with marketing, advertising, and snooping.
Upside move do you think is left percentage-wise in the S&P?
Well, we think it's just getting started in a rebound. And everything's just starting. It just started to rise in a megatrend, and this downward correction within the megatrend is just starting. So it sounds like they both have just started at the same time, but they have.
Wait, you said the downward correction is starting, but you're saying there's still a bump up in
the future. Because when we talk about the megatrend, we're looking at decades, a decade trend. And we're talking about the cooling for right now, we're looking at months. So these months ahead is when we think.
So she sounds like a bull actually on equities, where before they were withdrawing from the SPY. So I didn't conceptually grasp really tightly what they're doing. I understand different time frames. What is the macro trend? They're withdrawing, but not yet, because they're expecting a rally, but they're going to withdraw from the NASDAQ and the SPY, but actually they want to invest in AI. That's kind of confusing and slightly conflicting, and actually they just think it's a pullback now and we're going higher over the next decade. So there's a little bit of a dichotomy. I'm going to call time there. Gold and silver are about to take off. I didn't see the rest of this. Let's actually see if we can find where they discuss gold and silver.
Okay. 6 reasons to buy gold and silver. Now, what are they?
Well, one is number one is the interest rates, and but the reason is because we think that inflation is going to go with the interest rate rise, because they're not going to be able to contain it, and therefore gold rises in that environment very well, like it did in the 70s. So this is to be seen, but we think this interest rate change is a very bullish tick for the say one important thing for gold to rise, and silver. And then the next one would be the dollar. The dollar doesn't necessarily have to collapse, because they move opposite. Gold and the dollar move opposite, and they can move it together at times. It's just a major trend. See, we were focusing on the major trends today, and the major trend says they can move opposite. And it looks like the dollar will just kind of maybe not fall, maybe it will, or maybe it'll just become lifeless and go sideways. And that's probably what the government would want.
I don't agree with this assessment. So interest rates broadly typically haven't been great, but the failure of the debt, if you're referring to the other half of the system, which is return of capital rather than return on capital, it's not the interest rates going up, it's the part of the other side of the debt going down and people wanting return of capital. That's what you get with gold. It doesn't go away. It doesn't lose 75%. You still have it. You always hold it, and it's preservational. So I think that's what she means in point number one. Point number two, the dollar, she's saying the dollar either goes flat and dull or pulls back and goes wrong. You can have gold going up on a going up dollar. So one of the things I've just listened, I'm just hearing it at the same time as you, but let me just say the central bank buying is the main reason for me. That means they know the debt is failing. Everybody knows the Ponzi is failing. Everybody knows it's about the debt, and the Ponzi is failing, and currencies will fail with it, and everything will come. And they want to hold the thing that is preservational, not interest rate yield. Where nobody wants a yield, they just want to preserve capital. We've gone from search for yield to preservation of capital. I'm repeating myself. Let's hear what she says as number 3.
And so this is what we say is moving into number 2, because gold is looking a lot more in need, more and more. It's going to become more of a need for people and a desire to have. And the next was with the 6th reason, then central bank buying, how they're buying the biggest records since 1967. This is like a big change for them. They never have bought this much. So what are they fearing? They feel this insecurity. They don't feel that they can trust many countries.
It's not about trusting countries. It's the debt. The debt game is up. It's time to get out of physical currencies that are created by highly indebted nations that will not be able to stand by the debt implications. Thereby the currency dies with it. You don't want the risks of the FX. So we said 3 things will occur. Interest rate spike, the key part that everyone needs to understand, debt devaluation. That's the driver for gold. The asset class is collapsing in value. You want to get into something that holds its value. and preserves gold. The interest rate is just the other half of that. The third thing is the volatility that will induce on certain currencies dependent on which they do. So you don't want a whole treasury book of yen and Korean won and flipping Brazilian real and Mexican peso and US dollar and euro. You rather have less of that, run it leaner, and do gold, because that's always going to be in your vault. You physically hold it and own it. So that's how I'd paraphrase it.
And this is where all the divisions coming into. So that is bullish for gold, because they used to be net sellers, or they weren't buying at all. They weren't needing it. Now they do. They really want it for their security in their own country.
Yeah.
And so that was another biggie for gold bull market. And then we talk about, you can continue.
We're at number 4.
Yeah, we're at number 4, because she took over at number 4.
What we've just discussed about the economic uncertainty making people nervous, and the more uncertain things become, the more people want to turn to gold as the traditional safe haven, and then silver goes along for the ride. But and then the geopolitical uncertainty.
So people feel uncertain, and then geopolitical uncertainty are kind of the same thing. And the uncertainty actually deep down that they really understand is that they keep hearing about Moody's and Fitch downgrading debt, and America's no longer a good credit and is a bad creditor, and they have the sniffing suspicion that debt is going to fail. Again, the rates rise, one thing, but it's more generally rate rises in a normal, safe environment, not good for metals, because a yield is better in a bond. The collapse of the debt as asset class is terrible. All that money needs to flee somewhere before it goes to zero or low, 10, 15%. It flies into something that is preservational rather than yield, that will hold its own in price. And the more people run into preservational, the more it holds that price. And as that one bubble flows out, all that air flows somewhere else, one of the assets that will receive it is gold. So these are rehashed reasons: geopolitics, uncertainty, all of it. It's all about debt collapse. An asset class of debt is going to collapse. With that will be interest rate spikes, and as money is borrowed into existence, all the different currencies will be hyper volatile. That means they're no longer safe havens. Anything that has a high beta needs a much bigger return. They won't be giving a big return. They'll have spikes in interest rates and crashes in value. It will create immense risk. People are risk averse, so they will flee from currency and debt instruments, because both will be affected by the drama, into something that they hold and will always be there, and will actually go up in value as more people exit and go in there. So those are rehash reasons.
Put that on top, and then on top of that, the sixth reason is the technical. The technicals on gold and silver both look very, very bullish, like they're ready to take off. So you kind of put it all together, and it looks very good for gold.
And we've done many studies on gold for all these years, and we just have them in they're really well, and they continue to tell you the same thing. It's super interesting. And one is the big picture we have. It's called the gold is very cyclical. It's very cyclical, and last November was an important low, and it's.
The fact that the gold-silver ratio spiked to an all-time high as the bonds spiked to an all-time low yield and an all-time high valuation was a key moment that says the counterweight to debt markets is the gold and silver markets. That is what I would be saying. The spike in the gold and silver ratio hinged on March 2020. The spike in gold bond valuation spiked up in valuation in 2020, and the yield spilled all-time lows, seesaw, inverse proportion, at that point. That was the final capitulation, technically, if you want a technical chartist reason, for the turn in the bond markets, and the blow-off high in the gold-silver ratio was the final melt-up in the gold-silver ratio, which will now turn and go to the downside. That is the gold bull scenario. They are inversely proportionate. One gives a yield, and when things are groovy and the Ponzi is not about to burst, everyone rather takes a yield and sells short the thing that doesn't pay a yield and has a storage cost. Now, the preservation of capital is the priority. The yield is not a priority. It could be deeply unsavory and you could lose all your capital. You buy the gold and the silver. That's the argument. It's also the technical argument. And I'm going to finish this video because it's been long here. I don't know what more the ladies are going to say. I find it interesting. Good on them. They're generally right. Good on the interviewer. Thank you for the content. But I just thought I'd overlay my commentary to try bring my take of clarity on top of it. Hope you enjoyed this video, and we'll get it out, and hopefully you can watch it on Sunday. Thank you very much, and catch you later. By the way, don't forget to sub and like our channel, and you can book a call on the first link below for clarity in reset wealth building times where the old rules no longer apply, making sense of it all for you so that you can position to come out of one of the biggest globally synchronized economic events ever in any form of history that will be spoken about for hundreds of years in economic history of the future. We are here now experiencing it. You need to be smart. The traditional information is bad. The traditional advice is bad. You need to position well for this. Generally, these ladies are there or thereabouts. A little bit of wiggle there, but they seem to be in the right place, and congratulations to them. Until we catch you again, give us a like and a share. We appreciate it. Bye for now.